A very good afternoon, everyone. Thank you for joining the conference call for Q4 FY18 results of Adlabs Entertainment Limited. I'm very glad to inform you that this is the highest ever Q4 and the full year footfall for Imagica since inception. Imagica has been living the belief of providing world-class experience with Indianness in content, hospitality and pricing. Essentially, to provide best-in-class entertainment for delightful memories in a clean, safe and happy environment. Let me now begin with the FY18 performance. The year saw very strong growth in footfall in parks from 15.44 lakhs to 17.23 lakhs this year. This combines theme park as well as water park, and the overall footfall grew by 14%. With this, we are pleased to share that Imagica has crossed 6.5 million visitors in a span of just 5 years. Currently, we have penetrated only 16% of our primary catchment. Our objective is to comb the market further, thus increasing footfalls at a faster rate, simultaneously tapping repeat visitation through various exciting offerings. The total revenues for FY18 is at 236.29 crore, where the breakup is park at 201.27, hotel at 35.01 crore. This is against 238.99 crore last year, where the breakup was park business at 204.93 and hotel at 34.05. This is of course without the SGST refund component of 10.46 crore, which the company absorbed as we should be getting it refunded back from the state government. The real movement is in the EBITDA this year, which for FY18 stands at 62.67 crore versus 60.85 crore, registering a growth of 3% over last year. This of course is without the SGST refund of 10.46 crore, where we clearly would see an increase of 10.46 and thus it will reach to 73.13 crore, amounting to 20.2% of growth compared to last year. So effectively this would give us a margin yield of close to around 29%. The fourth quarter footfall increased by 6% on YOY basis from 3.97 lakhs to 4.21 lakh. The total revenues were at rupees 50.83 crore, where parks contributed 43.22 and hotel at 7.61. Vis-a-vis 55.66 crore last year, where parks contributed 46.32 and hotel at 9.34. This is, however, without the SGST refund component of 2.73 crore for the quarter. EBITDA for Q4 stands at 12.62 crore versus 11.82 crore, registering a growth of 7% over last year. Consequently, the EBITDA margins have also improved to 24.84% from 21.3% in the corresponding period in the previous year. This again being without GST refund of 2.73 crore. Therefore, EBITDA is likely to improve by 30%, which of course is a significant move up. Some of the key highlights and developments that we have undertaken in Q4 this year. So there has been a continued footfall growth that we have seen. This quarter saw a growth of 6%, which is primarily due to several initiatives that have been taken by the team at Imagica as a part of its long-term strategy. Holi Bash again continued to be a successful event this year, and we have yet again been successful in delivering a fantastic experience for our guests. On pricing and ARPU, we did see a drop of 8%, which again was due to the SGST component. Otherwise, ARPU would have been more or less been flat. The decrease in ticketing revenues is largely negated by the increase in the non-ticketing revenues, which grew by 11%. The share of non-ticketing revenues increased to 42% of overall revenues in this quarter from 35% last year. This has been a very conscious strategy to drive non-ticketing business as a part of propelling consumption through footfall multiplier effect that we have been pursuing. Apart from this, management has taken several cost consciousness initiatives on running the operations in a better way. This quarter, we are pleased to inform you that we achieved 13% cost reduction as a continued exercise largely from the employee cost and marketing and sales expenses. Since FY17, we have been making continuous efforts to optimize the operating costs of the park business through senior management teams taking larger responsibility in the form of additional portfolios, and on marketing front, medium selections and better partnerships have reduced spends, and thus the acquisition cost has been reduced as well. We have overall achieved a 20% reduction in the operating costs this quarter. In FY18 as a whole, we have achieved 2.5% of cost improvement through some of these efforts. We will continue our efforts for optimizing costs in the next year as well and maintain the rigor of tighter operations. On Novotel Imagica, in Q4, Novotel Imagica improved its overall ARR by 6% to rupees 11,458, including F&B, where room contributed 6,457 and F&B around 5,001 rupees. We saw good demand for corporate and MICE segments as well as social segment in this quarter. However, revenue dropped this quarter largely due to balance rooms approval which did not come through, which was expected in this quarter, and therefore we had to let go of some of the large group bookings and events. We are very happy to share that Adlabs Entertainment Limited has been announced winners of the Adventure Attraction Sector category for simulating excellence in the Indian travel industry at the VFS Global Times Travel Awards by Economic Times. These are very prestigious awards. We have also been awarded Preferred Theme Park Destination by Times Retail Icon Awards 2018. Moving forward to the strategy for reflecting on the strategy for 18 as well as the way forward for 19. At the outset of FY18, company strategy of focusing on footfalls and thus drive consumption, coupled with measures to improve EBITDA through various initiatives, has worked well. In FY19, we will continue to remain steadfast and further strengthen the approach on this path. With additional initiatives and new products that we would be launching, we would continue to improve footfall and the revenue streams therefore, eventually improving EBITDA margins for the business. Our partnership model of zero capex with partners like snow parks are working very well, and to strengthen this offering, as discussed last time, we have already soft launched House of Stars as a concept which is India's first official Bollywood-inspired 3D character museum. It essentially covers the timeline of Bollywood and gets to experience the sets of iconic Bollywood movie scenes and relive the character at a very attractive price of rupees 349. Further to House of Stars, we are adding two more concepts which are already operational with us. Additionally, first phase of Chota Bheem Alliance, where integration in Imagica parade and merchandise sales have become operational this April, and in the last week of May, Chota Bheem the ride will be launched in the theme park, where guests will be able to, first time in India, enjoy a completely character integrated roller coaster ride, which will be available starting fourth week of May. As you would know, the Chota Bheem character is highly popular among the Indian kids, and we expect strong footfall contribution and retail revenues from this alliance. Major focus area in FY19 is to make our balance sheet lighter. Last quarter, we announced the divestment of our non-core assets to reduce our debt levels. We have already signed term sheets to sell our hotel for a consideration of 212.5 crore and surplus land of 203 crores for rupees 150 crore. With this divestment, we would be able to reduce almost 30% of our debt. We have presented our plans to our lenders and awaiting relevant approvals. Post the debt reduction, debt would be at more manageable levels and companies making rigorous efforts for the same. I would now hand over to our CFO, Mr. Mayuresh Kore, to discuss the financials in details. Thank you very much.
Thanks, Dimant, and good evening, everyone. I will now talk about the detailed results for Q4 FY18. Coming to the details of footfall and ARPU. The footfalls achieved for Q4 FY18 are 4.22 lakh vis-a-vis 3.98 lakh for Q4 FY17. The breakup being as follows. Theme park 1.99 lakh, water park 1.13 lakh, and snow park 1.09 lakh. The theme park and water park revenues combined stand at 42.48 crores, for the hotel at rupees 7.61 crore and snow park at rupees 0.74 crore, and thus total revenues for Q4 stand at rupees 50.83 crore. The revenues for the 12 month ended March 2018 thus stand at rupees 236.29 crore as compared to rupees 238.99 crore for the 12 months ended March 2017. The gross realizations per visitor for Q4 are as follows. The weighted average ARPU for the theme park and water park combined in Q4 FY18 is rupees 1,357 versus 1,477 in last year's Q4, a reduction of 8%. Overall for FY18, the weighted average ARPU for the theme park and water park combined is rupees 1,422 versus rupees 1,644 in FY17, a reduction of 14%. The EBITDA for Q4 FY18 is rupees 12.63 crore versus an EBITDA of 11.83 crores in the previous quarter FY17, an increase of 7%, which is commendable despite the revenue impact arising due to higher GST and other factors. As you are aware, the management efforts this year were directed towards increasing footfall and improving margins. Accordingly, the EBITDA for the full year FY18 is rupees 62.67 crores versus EBITDA of 60.85 crores, a growth of 3%. As Dimant mentioned, if one considers the GST refund amount, the quarterly and the annual EBITDA amount would be higher by 30% and 20% respectively. Coming to the hotel performance. The hotel is continuing with its strong performance and has thrown a capacity utilization of 68% for Q4 and an ARR of rupees 11,458. The breakup of ARR is as follows. The room ARR is rupees 6,457 and the F&B and other ARRs is 5,000 rupees. The total ARR being 11,458. For the 12 months ended March 2018, the hotel occupancy was a strong 76% and the ARR corresponding, including F&B, was rupees 11,078. As Dimant mentioned, the cost initiatives that have been taken, so I'll just elaborate the cost-related highlights in the quarter. The overall Q4 operating costs, including the hotel costs, have declined by a significant 13% compared to last year's Q4, from rupees 43.84 crores to rupees 38.20 crores. In this, the cost related to employee benefits have reduced by an absolute amount of rupees 4.94 crores, which is a 36% reduction resultant from strategic manpower rationalization. The cost related to advertisement, marketing and sales have come down by an absolute amount of rupees 2.57 crores, a 21% reduction due to our continuous efforts in improving spend efficiencies. Notably, cost of acquisition per customer would have come down due to these efficiencies as well as the increase in footfalls. The overall expenses pertaining to power, fuel and water could have been lower, but for a change in mix due to regulatory changes wherein minimal drawal from MSCD sale has been increased. The power, fuel and water costs therefore stand at rupees 3.82 crores versus rupees 2.95 crores. However, we are continuing to explore options for solar power to bring down the average cost per unit for power. For the overall financial year FY18, the operating costs, including hotel, have declined by 3% compared to last year. So from rupees 178.14 crores to rupees 173.61 crores in the current year. The average rate of interest on our borrowings is 11.4%. Accordingly, the finance cost for Q4 is rupees 30.87 crores. The bank loans outstanding as on 31st March 2018 are rupees 1,023 crores. Some GST related updates we may have updated in the previous quarters, and we are happy to reiterate that after sustained representations from the company and the trade body, the GST Council had finally reduced GST rates on park tickets from 28 to 18% with effect from 27 January 2018. So in this current quarter, we had 1 month of the higher GST impact. However, the next financial year, we should have the full benefit of the reduced GST. An update on the matter of the GST refund component, we would like to inform you that it is at a very advanced stage and is expected to be tabled forth the state cabinet in the coming few months. We would now like to open the floor for questions and answers.
Thank you. Ladies and gentlemen, we will now begin the question and answer session. Anyone wishing to ask a question may please press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Vipul Shah from Sumangal Investments. Please go ahead.
Hi, good evening, sir. My question is this GST refund will be one time or it will be this around 2.5 crore will be recurring every quarter?
This is a recurring income. So for the previous financial year, since it was at 28%, the SGST component was 14%. And this will be a recurring amount, which is every time the 50% of the GST component, that is the SGST share, will be accruing for refund for Adlabs. Since it's a new mechanism, that is why it has accumulated to such a large sum now. Going ahead, it will. We are awaiting the mechanism for the calendar for the timing of it.
So, what will be the lag between quarter end and the payment in terms of time, in terms of months?
Look, since this is the first time it's getting implemented, so right now we've already accumulated 10.46 crores for the financial year FY18. So we are expecting a 3-month lag, between the actual quarter end to the receipt of the refund amount. So it will be a kind of a working capital requirement which will keep ongoing till the government improves any efficiency factor here.
So since GST is reduced from 28 to 18, so should we build in instead of 2.5 crores a figure around 1.75 crore for the subsequent quarters? I mean for the current quarters?
No. So the current quarter Q4 it was 2.73 crores.
From first quarter onwards.
Yeah. 50% of the 18% applicable rate on ticket sales, so will be due for refund. So it will vary from quarter to quarter.
Roughly, what should be the figure we should pencil in? Considering the footballs are same.
Yeah, so example for quarter 3, we had 5.22 crores which was accrued as the GST refund credit. Whereas Q4 is at 2.73, this is primarily due to the nature of the business, right? So 5.22 crores can be considered, which was at 14% becomes 9%. So technically you can take closer to 4.5 crores of value for quarter 3, and for quarter 2 you can be at about 2.5, 2.4, not really at 1.75 as you said, because part of the quarter was at 9% and a small portion of the quarter was at 18%, 14%.
Make it simpler, just take it 9% of ticket sales.
9% of ticket sales.
Okay. Yeah.
And sir, my second question is we are seeing continuous decline in ARPUs for quite some time. So, what is the reason for that? And I would like to know the cash and net break-even for the theme parks in terms of number of footballs.
So, the first thing about ARPU reduction is twofold reasons really. So, one is since we are not able to recognize the GST component which goes out of our kitty, the reduction of 9% is clearly to the extent of what you would see in the ARPU straight away. And this gets coupled with the mix of the business. So when theme park and water park mix changes even by 4-5%, there is an impact. So as such, there has really been no pricing change that we have made. And in fact, despite GST, when it was at a higher rate, we retained our prices, but we passed on the benefit to the consumer in form of discounts such as Save GST. So we do not see ARPU softening really for theme park and water park business. In fact, this is the least that now one can really expect. There will be new initiatives that will be coming in, but that would really not take away the ARPUs. So that's how, that's what I can really say about the ARPU part of it. Yeah.
So if you strip out GST impact, what you are trying to say is ARPUs are more or less flat.
Yes, sir, absolutely. So ARPUs are at the flat number only. There is really no reduction if you add back the component. And secondly, the non-ticketing business per se has really taken a good upswing. So it kind of negates the total overall ARPU of the business. But on ticketing, like you rightly said, it's primarily SGST component.
And what is the cash and net break-even in terms of number of footballs, if you can give?
Yeah, at the current realization, post the debt reduction, we will have cash break-even at 1.8 to 1.85 million footfalls. We will be achieving cash break-even. If the asset sale happens sooner than later, we'll take 12 calendar months after that to achieve a cash break-even because primarily, sorry?
So, at our current footballs, if we can achieve this deleveraging, then we should be able to cash break-even in next year.
Yes, yes. So, that's really the major activity that the company has taken up because that's really the problem area that we are addressing.
Because from the, as you're aware, from the asset sale, we'll be saving 41 crores of interest, and of which the land component itself, which is not fetching any revenues as of now. So that if that gets taken out, we stand a good position to achieve cash break-even in a full financial year.
But we don't seem to have any progress on asset sales, at least till now. So what is the status for both hotel and land sale?
Yeah, so today where we are really, so there is actually there is a significant progress, but unfortunately till such time we do not get the NOCs from the lenders in our possession really. Till such time we can't conclude. But with the lenders really there has been an advanced level of conversation, and the papers actually have moved to their committees. So we hope and expect that very soon we should have clarity on the NOCs. So really speaking, all the approvals except lenders is really available, is what is awaited.
And practically, because the consortium is large with 13 lenders, and as you're aware, most PSU banks having their own kind of constraints are taking time in processing. But we are making full efforts to expedite these approvals and to complete the asset sale.
And any new ride additions to increase the attractiveness of the theme park this year?
Yes, sir. So we have already added, like I said, Chota Beam as a ride will get fully functional in the 4th week of May, which is in this month itself. So once we have that operational, and the House of Stars as a concept which is very unique Bollywood-inspired attraction. These two are very good talk points for business really, and we will unveil the campaign. So House of Stars, we've just started the campaign. Chota Bheem campaign, I'm sure you would have seen already visible, and it is started to draw interest and attention. We are sure that in Q3 and Q4 of this year, it would really help us in a big way. So these two are big attractions. Apart from that, we have made certain changes within our premises to accommodate 2 more new concepts, and we very soon would be coming up with a very attractive proposition for lean seasons, and that you would see unveiling very soon.
So can we expect a significant increase in footballs this year after this Chota Bheem and this with the addition of Chota Bheem?
Yes, so what we, the way we have laid out our plans are keeping in mind some of these big talk points. We would like to maintain the run rate of growth on similar patterns as what we have achieved. So that itself, coupled with the debt reduction, we think would take us really to the cash break-even levels, plus the efforts that are constantly happening in the past to increase and generate a better value proposition for customers continues to be our main goal as a business.
And I'd like to add to that, with the growing footfalls and higher visitations, the chances of sponsorships and alliances are brighter, because and in the current year as well, we have kept some aggressive targets for ourselves, and that could be an added stream in the coming year.
Okay, sir. Thank you and all the best for the future.
Thank you very much.
Thank you.
Thank you. The next question is from the line of Kunal Parekh, an individual investor. Please go ahead.
Yeah, hi. So, couple of questions. One of them was regarding the Shan Agro deal, where you have come up with a notification that lenders have refused to part their debt on their books. So, is it like now Shan Agro will pay Adlabs 150 crore and that will be paid to the lenders?
Yes, you're right. Actually, there were a few lenders who cited technical constraints for the transfer of debt, from one book to other, which there were precedents, but since it's a large consortium and to avoid any potential complications, we requested Shan Agro for a cash consideration of the same amount, the commercials being unchanged, and they have agreed for the same. And upon receipt of the bank NOCs for such sale, the transaction will conclude soon.
Okay, and regarding the Novotel deal, why are we not able to close that? Because that had no debt transfer. It was a straight cash deal where you were getting money from Mr. Damani. So what is the problem there?
Yeah. So on the Novotel transaction as well as the land transaction, we have a consortium of 13 lenders whom we had presented both cases simultaneously. I mean, both NOCs, as you're aware, in the banking system, the entire process moves first with the leader and with everybody else in the same manner. So both of the requests have been put together because we had targeted a very significant debt reduction of 30-35%, and the banks were also partaking with their securities. So while they evaluated, did all their valuations and their diligences, both of them were combined. And while we addressed the Shan Agro technical issue in the interim, both the proposals are moving simultaneously. So unfortunately, they couldn't be isolated from each other because that's the way the banking system moves.
So we don't need any other permission from, say, any government agency or corporation. Apart from lenders, we have all other approvals.
Yeah, we do not need any permission from the government as such.
No, in the sense OC and everything, we've got it now.
Yeah, we've got it for the hotel.
Okay. And the QIP raise that of 200 crore. So you might already be aware of the stock price and the valuation. Now this is a considerable ask, and so you haven't cited any valuation. it will dilute a lot of the current shareholding. So what are the thoughts on the valuation? Because we have been raising money for quite some time at lower valuations for some time.
So couple of things. This is purely an enabling approval, which as a secretarial practice, we also took in beginning of the previous financial year. So there is no specific plan as of now at the current valuations to do anything. It just facilitates your secretarial approvals as and when we are at a better valuation and with a firm plan. So that was one point. And as of now, we've actually not, apart from the 50 crores raised from Shan Agro, which is as part of the overall deal, we haven't raised equity. We had taken a 200 crores approval last year, but for a QIP, but we only did a preferential allotment of 50 crores last year, apart from the warrants, which is to Times of India brand capital for the advertising and the marketing expenses we do. So this is just enabling, and going forward, obviously, we'll come with specific approvals at a hopefully better valuation.
Okay. So, in the next coming year, you want to reduce debt by 35% or scale further to more 200 crores? So what have you planned for debt reduction in all?
The same, the asset value of, because the commercials for both of the non-core assets remain the same. So the 30-35% debt reduction target which we have is well on course. I think there is no change there.
Okay. And in terms of the Chhota Bheem deal, how much are we paying is it like the vendor deals which we have done with Snowpark or the House of Cards? Because is it on the same line, like revenue sharing?
We are bound by the confidentiality agreements with them, and therefore I won't be able to really disclose that. So
okay. Fine. I'll get back to the team.
Yeah. Thank you.
Thank you. The next question is from the line of Shruti Patel, an individual investor. Please go ahead.
Yeah, good evening, sir. My question is on the footfalls. So, you have grown the footfalls by about 6% this year for total footfalls. But if we see category-wise, Water Park has grown by 26%, Snow Park has grown by 12%. This is for the quarter, sorry. But the theme park has actually gone down by about 10 or 11%. Is that right?
No. The theme park footfalls for the year are up 6%. The Water Park 26%. And if we just average out both of these, it's 14% growth in the theme park, including Snow Park. Footfalls have grown 12% year on year.
Only theme park footfalls have grown by what percentage for the
6%.
Quarter?
This is the full financial year.
Full financial year. Okay. So you've grown it by 12%. Okay. And the other question I had is on this SGST refund. Now you've been saying that is what you just mentioned in your speech that you are going to table it this month. But I just wanted to understand. So is this disputed, or is this just we know for sure, and is only we are awaiting for the timelines, or how is it? Like this 10 crore or recurring amount is definitely coming, or what is the possibility of this not coming? Because this is it this in lieu of this entertainment tax that you had got waived?
Yeah. So basically we have Adlabs Imagika being a mega tourism project declared by the government of Maharashtra, enjoys a 100% entertainment tax holiday for the next 10 years, and which is there till 2024-25. And since entertainment tax has got subsumed under GST, and now the center collects and distributes the SGST share back to the state, so the entire 100% SGST component, which is basically in lieu of the e-tax, has to come back to us. And since it's a new mechanism with the state government, and not only us, there are 20-30 others who enjoy various exemptions in the previous regime. So the entire file is moving. So it's moved from various departments of finance, revenue, treasury, industry and planning, and finally the state cabinet has to approve this. So we don't see any reason of being denied this because this is one of the basis of the investment made by the promoters in the state of Maharashtra.
Understand. So it's only a timing that you're in.
If it's only a timing, and if there's any delay or something, we may contemplate even legal action so as to put it in case of any delays. Right now, since we understand that GST is a new concept, things are settling down.
Right.
But because it's a rightful claim to it.
Right. So my other question is on the debt. So if I understand correct, we had our repayment for debt was to start in June 2018, right?
Yes.
And given that we've got, these deals on land and hotels have taken a little longer than we expected, what is our plan for debt repayment in case these deals take longer?
Yeah, so what we have requested the bankers, since from our side we had already worked out the commercials for the sale of asset and applied to the bankers well in time, we have proposed that from the sale proceeds, the immediate installments be recovered first. So basically the installments which are there for the next 2 to 3 years will get taken care of is what we have proposed. In usual cases, it is usually proportionate repayment of installments. However, we have done this in the past from our IPO where we have prepaid installments, immediate installments in advance, and thereby giving further time for the business ramp up to happen. So we have requested lenders in the similar fashion, and earlier they approve. I'm sure the immediate installments will get taken care of, and for the remaining debt, then we can look at whatever refinancing options with a lighter balance sheet.
Yeah, so but my question is, in case these deals get delayed, because we have to start it from June, right? And we're only a month and a half apart. So if these deals get delayed, then do we have a backup plan for this debt repayment, or how does it? Because first payment must be due in June, right?
Yes, so we are meeting the bankers, in fact, on Monday for the same subject, and there would be clarity that we will have, and accordingly we'll have to plan. So one thing that we have clearly spoken to them, and now the discussion with the consortium has gone to the highest level, wherein which we have already flagged off the importance and the need to grant us the NOC at the earliest. So I think we will be able to answer this question once we have a clear from the bankers themselves. We can come back to you.
Sure.
But your question is very valid, and I must appreciate it. Yeah.
Thank you, sir. And there was a while ago that our debt was classified as SMA2, right, for some interest delays or something. So now all that is cleared?
The basic reason why we are selling off the non-core assets is because of, such as the land where 150 crores of this debt reduction would save us about 18-19 crores of interest, and so from the hotels. So the idea was to, whatever the interest gap is there is reduced so that the core business which can sustain only a percentage of the debt. So till the asset sale happens, there will be a strain on the interest payments, but without, in absence of any inorganic methods, whether any equity infusion or any, we are also requested the hotel buyers for advances where we could streamline this. However, all is hinging upon the bank NOCs now. The sooner they come, I think we'll come back to a manageable debt level.
Understand. And so what is our EBITDA excluding hotels?
Hello. Excuse me, ma'am, maybe request that you return to the question queue. There are participants waiting for their
Thank you.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all participants in this conference, please limit your questions to 2 per participant only. The next question is from the line of Manish Rawat, an individual investor. Please go ahead.
Hello, sir. Good morning. My question is on...
Sorry to interrupt, sir. So can you speak a bit louder? We are not able to hear you.
Yes. So my question is on the locational benefit that the Adlabs have. As the airline traffic has increased dramatically, are we looking for the areas like beyond the primary and the secondary catchment that we have?
Yes, of course. So, as you know, Imagika is a national holiday destination, and we do promote Imagika across the country depending on the seasonality. So, you will see that while, of course, the inbound traffic and the primary catchment gets higher advertising visibility, catchments, example, Karnataka or Andhra, where the Ugadi and the October as a season is higher, or similarly in up north when December becomes a bigger month, we plan our campaigns very strategically so that there is no spillover in terms of media spend. At the same time, we time their availability of time apart from pure the visitation needs. So we have to really sync that, and that's what we do. So, of course, our efforts are sustained, and that's why we have partnerships with companies such as Make My Trip, who are, or Jet Airways for that matter, who are travel-enabling formats or companies, and that really works well. So, of course, it is actually pride of India as a entertainment destination, and that's something which we would like to keep promoting.
Thank you. And my second question is that given the Adlabs has established as a brand of a theme park, are we also looking for to establish other areas that's more dense, like the NCR areas where the people generally do spend a lot of money on the entertainment, and we don't have any theme park over there with that, like the Imagika can deliver them?
Yes, of course, as company we want to expand, and you would have seen that in past we had announced the two potential locations that we had very seriously explored. However, we as a company took a pause to first make sure that we are debt light and we stabilize the current location and format and then expand, which I'm sure you'll appreciate. And moment we reduce 30% of debt, and when the numbers are more manageable on the debt front, being an operating leverage, this is the most logical thing for us to do. And with the kind of IP and the assets that we have built, it is meant for more than 2 or 3 locations depending on the size and scale. So we are definitely wanting to do that, and we are committed to do that. It's just a matter of time.
In fact, we are happy to inform that at the current stage, at least 5-6 different geographies have been consistently approaching us as the Imagika brand to come up in various joint ventures or alliances to realize the potential of this in the various catchments across the country. So we continue to keep track of those, and as Dimant mentioned, as we complete our debt reduction, we will definitely initiate those.
Thank you, sir. Thank you for answering.
Thank you. The next question is from the line of Bimal Sampath, an individual investor. Please go ahead.
Yeah, good evening. 2 questions. One is that hotel sale is through. Will our F&B revenue come down? And second thing, will we get commission on hotel booking, which will happen through our site and all that? And what are the other operation revenues? Hello?
Yes. So your first question, the hotel has a separate stream of revenues and so has the park. In the balance sheet, the F&B used to be combined as one revenues where some F&B of the park as well as in the segment revenues, the food revenues used to be highlighted, but those are purely separate. I mean, the hotel has his own business unit and the theme park as a business unit operates separately. So things will not change. the understanding with as part of the hotel sale is that existing arrangements that the park has with the hotel in terms of packages will continue as it is. There will be no change in the understanding or the sharing from the current levels. And as a consumer, obviously, as a package, you will continue to enjoy the combo package with the stay as previously.
So the way we have designed our entire structure is that like Novotel, Imagica, although it is a part of our stable, and we work on transfer pricing with Novotel, and that's how we operate with other players where we do any joint business, and that's what will continue. So it's really not a problem, sir, on that front.
So actually, last year there was a loss of 7 crores on the hotel business. So that will go off next year, no? Once we transfer the hotel.
From the hotel, the hotel has thrown EBITDA of 6.5 crores for the full financial year FY18. If we take the depreciation corresponding, I'm sure, but we have to really note that 171 rooms were not operational in that year, and I'm sure in the next 3 months or so it will be less consequence once the new buyer takes over the entire property and the depreciation ahead.
Okay, and what are the other operating revenue?
For the other the other income, other operating income includes parking, the car and bus hire that we get, and sponsorships to that extent. So these are form part of the other operating income.
Okay, thank you. And merchandise, now with new tie-ups, will we have a jump there? Do you expect next year or 2 years?
Yes, sir. So, on the footprint of retail merchandise, we are getting a very positive response from the partners whom we are already present, as well as there are new tie-ups which are already being done. So we have already completed one tie-up in Gujarat, and now we are actively looking at other parts of the country, and we would be ramping this business very strongly.
Okay, thank you. And what is the CapEx, one work in progress?
Excuse me, sir. May we request that you return to the question queue?
Okay, thank you.
Thank you. The next question is from the line of Jigar Shroff from Financial Research Technologies. Please go ahead.
So thanks for taking my question. So what is the CAPEX plan for FY19?
All our repairs and maintenance activities, which we need to do as part of the park are part of the P&L, and as we explain, any addition to rides, we've taken the model where any partner can come up and invest into any new attraction, and we'll be happy to engage on the revenue share. So apart from the regular ongoing maintenance activities, we do not anticipate any capital expenditure.
So any ballpark figure that the repair and maintenance that you would have to incur other than what the partner incurs?
No, for the new attractions, the partner incurs the entire CAPEX. Correct. The maintenance is part of our P&L, which is already part of our operating expenditure, and it will be continuing at similar levels as previous.
Okay, similar as the previous level, okay. And sir, after the divestment of these two debt reduction, what would our debt come down to approximately? Currently, it's 1,023 crores, you said, right?
Yeah.
So then it will come down to approximately?
Yeah. So we're planning 740 to 750 crores of residual debt after clearing all the outstanding debt and dues.
Okay. And what is the scope for further cost reduction initiatives? So which areas would you look at, sir, for the current year? Besides, you said you were looking at some solar initiatives also.
Yeah. So solar is, very much an active conversation which we are having with multiple vendors for a long power purchase agreement. And since our consumption of power largely happens during the daytime, I think solar is a apt mechanism where we could reduce our power cost. So we are in talks with 2-3 players, and by October, November this year, we should have our solar plans, solar implementation in place, which has scope to reduce the power cost. Apart from that, we've become really cost conscious in terms of all other expense buckets as well, and we keep looking at chances where we could really optimize our costs, and there could be some efficiencies coming further. However, major part of the efficiencies we've built in over the last couple of years, as you may appreciate, we've gone a long way in bringing down the fixed operating cost. And importantly, the focus should be to inch up the revenues, because being a high operating leverage and a fixed nature of cost, I think there is real room for growing the EBITDA margins further.
So the solar power initiative would reduce your cost by how much, sir? In terms, you must have done some calculation, I guess.
The unit rate obviously will be lesser, but the quantum of exact power savings, we will come back to you, because we are talking with multiple power suppliers to that extent. But from the overall power cost, one could really expect 15-20% savings in the current year.
And what is the current power cost?
Currently, we are using a mix of MSCDCL drawal and some access from open access. So, an average, we are at about 17 crores per annum.
17 crores is the per power cost per annum.
Yeah.
Okay. And sir, what is your outlook on the non? Just one last question, ma'am. Just one last question.
Maybe request that you return to the question queue. There are participants waiting for their turn.
Okay.
Thank you so much. The next question is from the line of Shruti Patel, an individual investor. Please go ahead.
Thank you. My question is, what is the EBITDA excluding hotel for the year?
Yeah, it's 55.63 crores excluding the hotel, and the hotel 6.5 crores.
Okay. And in your balance sheet, there's a line item called Other Financial Liabilities, which was about 40 crores last year, which has grown to 130 crores. So I wanted to understand what is in there.
So as accounting standards, the principal installments due in the coming year have to be included as part of the other in the current liabilities. So this year we had to classify in the other current liabilities, and also we've taken against the sale of the hotel, we've taken a 15 crore advance, so that's also figuring in that. So that's where the amount has increased.
Okay, no, because there is a separate item called borrowing also, so I wasn't sure if liabilities was included there. Okay.
No, it's included there.
Okay, thank you so much. That's it.
Thank you. The next question is on the line of Jigar Shroff from Financial Research Technologies. Please go ahead.
So what is your outlook on the non-ticketed revenue? It's gone up about 18% in FY18. And, some cases, what is the trend globally amongst all these theme parks? So, so whether we are moving in that direction.
Yes, so we are very much moving in that direction. And if you look at the parks in India, there is a huge gap between what we do on the non-ticketing compared to what other parks do. So technically, a good mix really. So currently we are at about a 65-35 kind of a ticketing to non-ticketing mix, and we would like to take this share to about 40% in this current year. And as we move our merchandise and the retail business out, we would have a better push to that. That is really the trend globally as well. And that activity particularly takes some time to build up, and that's exactly the journey we are on, as you rightly indicated.
So 65% ticketing should come down to approximately 60% in the medium term.
Yes.
And 40% would be non-food, beverages, and that other merchandise, etc.
Yeah, so for Q4 itself, we've touched 40, but the year-long performance for us is 35, so we are very much on that trend. And with any further inclusion of any merchandise alliances that we can crack in, we'll only add to it. Yeah.
So the QIP that is that enabling provision, that is primarily for what? I mean, for expansion or for further debt reduction?
The last year we had taken this approval with a view to do a combination wherein there were a couple of expansion opportunities as well, and from the after that, of course, the asset sale options came up. So it may be used based upon the requirement, and as I mentioned previously, we have not firmed up an exact amount and also the current valuation. We are not very keen on jumping on it right now. So I'm sure the plans will unfold over the coming months, and it could be used for a mix of growth as well as some further pairing of debt.
Okay. So how confident are you that both these debt reduction initiatives should go through in the June quarter?
We need to do it, as I think Shruti I had mentioned in the previous call, that timing is very essential, and the groundwork, the legwork has been done. I can assure that over the last 4 months we've been at it, and despite the upheavals happening in the banking sector, we've completed all their requirements of valuation, certifications, everything which is required. And as explained, the banking sector is extra cautious for any release of securities, and everybody kind of before affixing their signatures on any documents want to be doubly sure in this current scenario. So which we have done, fortunately, and now it's really up to the banks and the proposal at the highest level, at the lead bank, and I'm sure we should do it in a couple of months.
Yeah, hopefully if not June, by September quarter it should go through. Sure.
100% it should.
And so your average interest cost currently you said is 11.4%, correct?
Yes.
So with this debt reduction and all, we should expect some kind of an upgrade which should lead to a further reduction in our average interest cost?
We have plans to, we've already been discussing with credit rating agencies for a due upgrade based upon the reduced debt component, and with the core business scaling and the footfalls looking encouraging, we will definitely go for a higher credit rating. And as far as the interest cost goes, definitely we'll be happy to reduce by a further half a percentage point or one. But obviously we don't know how the interest scenario pans out considering inflation and other factors. So we'll be watchful in that regard.
Okay, sir. Thank you so much.
Thank you.
Thank you. Ladies and gentlemen, that is the last question. I now hand the conference over to the management for their closing comments.
Thank you everyone for participating in the Q4 conference call for Adlabs Entertainment Limited, and we're really happy with the questions and hope that we've addressed them satisfactorily, and thank you.